Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, and welcome to the Stock Spinoff Investing Podcast. I'm your host, Rich Howe, and I'm really excited to have Andrew Walker on the podcast today. Andrew, how you doing?
Hey, buddy, how's it going?
Good. So super psyched to have you on the podcast. I followed you for a very long time. I think the first time I was following you was when you were publishing a site called Whopper Investments way back in the day. And that
Long
site
time
I think
ago.
is no longer live, but I think there's some old Whopper Investments write-ups on Seeking Alpha, which I checked out today. And it's just been fun, watching your progress, watching you develop as an investor, grow an amazing blog, premium Substack, and just see where you've taken your podcast, which I think is like the premier investing idea podcast on the planet. So, but would love one thing in thinking about you that I didn't realize is like I don't. Whenever I'm listening to a podcast with you, it's always you interviewing somebody else. And I don't really know that much about your background. Like, how did you get so interested in stocks, where you grew up, and then how you got to where you are today? So, I would love to hear a little bit about your background, and then we'll get into stocks.
All right, cool. Okay. It's a little bit different. It always takes me a second to be on the other side of the mic. I'm so used to driving conversation and asking. So, look, background, I'm sure people don't want to hear like I grew up watching Michael Jordan or something. So, the relevant background. When I was always into numbers. My dad was a banker. And when I was 15 or 16, I came into like $1,000, right? Like I think my grandparents had bought some savings bonds and it kind of came my way when I was 16. And my dad said, "What do you want to do with the $1,000?" And my dad's a banker and I'm into numbers and like a good little banker son, I said, "I want to save it. I want to save it for the future." And my dad, I could tell he was proud of me. So he's like, "Oh, great. I'm going to set you up with my Ed Jones guy and he's going to do right by you." So, I go into the Ed Jones meeting and I put on my nice collared shirt and everything. And we go meet the guy in person. He's got a firm handshake. And he's like, "Look, I know you've been, and I've done a little bit of reading." He's like, I see you know what you want. You're young. We're going to put you into an emerging markets portfolio, and it's going to be, high volatility, but it's going to be the best. You've got 40 years. This is going to help you in the retirement." I was like, "This is awesome." So I did that, and it was like June, right? My birthday's in June, and I get the July statement, and my $1,000 has become, I think it was $908.76, right? And I called him up and I was like, "Hey man, we lost $90. What happened?" He was like, "Look, market's volatile. It's been soft." And this was probably June of 2006. So markets were like kind of just topping, if you kind of remember that time. No, it must have been a little bit earlier, but markets were volatile. He said that. And I was like, "Man, I was so into it because this was $1,000. This was a lot of money to me. I was so into it. I was following the Wall Street Journal. I was like, I don't remember like 10%." So I looked at the statement and there was the markets were down 3%, and there was a 5.25% charge for what is it, the Class A charge for distribution. And I asked him, and he was like, "Oh, that's my fee, for getting you into this fund." I was like, "F man, I just gave this guy $52." And I remember because I was working at the time and minimum wage in Louisiana was $5.25. I was like, that's 10 hours. I was working 8 hours days, 5 days a week. I just gave more than a day of pay to this guy. And I was like, that feels crazy to me. So I bought, it was literally like investing for dummies or retirement for dummies or something. And the first thing it says is you should not play Class A fees, right? There's the load mutual funds and the no load mutual funds. And I was like, "Oh man, I got taken for a sucker." So I was like, "I will never pay one of those again." And it's been a huge debate with my parents. I am always like, "You guys cannot trade with Ed Jones," and my dad just loves the guy, and he's just living proof. Once you get comfortable with something, there's a lot of behavioral biases in anything. So anyway, that's my like origin story of how I got into investing. And so I was immediately like, I bought the John Bogle books, and I was like, I'm going to be an index investor. But any numbers person, and I remember when I was like 6 or 7. I would get into an Excel spreadsheet and I'd say like, "Hey, if I could save $100 a month and drag it out over 30 years, and then you change the rate of return from 8 to 9%, what happens?" And you get so much more money. The Warren Buffett snowballs kind of. And so I got really into the bogglehead stuff when I was 16 or 17. But then I was like, "Oh, well, this is maximizing, like minimizing the fees. But what if I could go from like the index return to index return plus 1% or index return plus 2%?" And a couple reading the Boghead books was like, hey, the one exception is I actually think I started with Peter Lynch because he was very big at the time. He had beating was it beating Wall Street or One Up on Wall Street or whatever. And then you find a Buffett book, right? You're going to find a Buffett book and come to Berkshire and worship at the altar. And I just became obsessed with, hey, how do you go from the 8% to the 9%? How do you add a little bit more alpha? And I was obsessed. I remember freshman, sophomore year of college, I would literally sit in the back of rooms and sit in the back of the classroom, and I would be reading 10Ks on my computer while the teacher was professing. So I knew like I wanted finance, I wanted investing, something about the stock market and investing just appealed to me. And you mentioned Whopper Investments, like I knew I wanted to be entrepreneurial, I wanted to invest my own money. I started Whopper Investments when I was like a junior in college, and I'm sure I would be embarrassed by all of the writing and all of the ideas at the time, but it was a passion for me. And one thing I tell students when they reach out to me or anyone, like you just need to start investing, you just need to start trading, you just need to start writing, and anything you do 5 years later, you're going to look back and probably be embarrassed by it. And that goes for the best authors. I'll hear them say about their first book they're embarrassed by 1,000 things they did, and these are guys who their first books were like New York Times absolute bestsellers. The best NBA players, they'll talk about their rookie years, all the silly mistakes. Like everybody's going to make mistakes, and the nice thing is when you're young, you're doing it on a very small scale. You're going to earn more money, but you just got to start doing it. So I look back and I'm embarrassed by a lot of stuff I did at the time. I look back on stuff I wrote 3 years ago and I'm embarrassed by it. 3 months ago and I'm embarrassed by it. But just keep iterating, keep evolving, and that type of thing. So anyway, that's my whether it's superhero origin story or supervillain origin story, or I'm probably just an NPC and it's just my origin story and nobody really cares. But that's the whole thing. I'll kind of pause there and we can talk about any piece of it you want.
Yeah, so where how did you get from there to did you go what did you do right after school? Did you get right into investing?
So right after school, I went and worked at JP Morgan in private wealth management. And it was one of those things, I had no clue what the F I was doing. And I got it. It was a height of GFC, I graduated in 2010 and I interviewed at JP Morgan. It's like the only place I interview. I get a job offer. I'm like, this is freaking awesome. It's in private wealth management. You go and they're like, hey, you're going to be managing rich people's money. You're going to be on the investment team. I'm like, this is awesome. And then you get there and it's basically an asset gatherer, right? It's Edward Jones and another name. And all the people who were there were absolutely wonderful. But, I think my analyst class had 200 people in it. And for 160 of them, we got there. And for one reason or another, everyone like within a week was, they kind of knew it wasn't for them, just that side of the private wealth business. But for 40 of them, they were like, oh my God, this is the best thing. Like that is what they were done for. So if it's meant for you, it is meant for you. I knew right away it was not meant for me. So I was at JP Morgan for a year. Was pretty clear I wanted to switch, was studying for the CFA at the time. I got a job offer from McKinsey in their valuation division. This is if you've ever read Valuation, which is on the learning book that a lot of investment banks, I don't know if they still do because I'm not in investment training anymore, but a lot of investment banks would hand out. It's used as a textbook for a lot of MBA courses in college. This is that division. So I worked for that author for 2 years, really enjoyed it. And then I got an offer at a private equity, private credit firm and went there for a couple of years. So that is kind of my background there.
Very cool. I can't believe you were in Excel at 6 or 7 years old doing
I,
compound math.
I
That is
mean, maybe it wasn't
impressive.
6 or 7, but it was damn like I was
It
in
was
grammar
young. It was
school and I
young.
remember. No, it's not like I was building crazy models, like I'm sure again, I was just fascinated by 8% per year. You do it over 30 years and you save $100 per month or whatever, which was massive money to me at the time. But that gets you a pretty great retirement, and you play around with it. And I remember being like, oh, if you change 100 to 110, it gets you this number, but you trade the 8 to 9. It was just crazy how you trade. So I was just always fascinated by the compounding metric.
So last question, last background question before we dig into investments. Uh, one thing that I love every year that you put out is you do like an annual review of, I think you call it the Yet Another Value Empire, facetiously. You got your podcast, you got your blog, you got your Substack, which I'm a very happy subscriber to. And I love just reading about your goals, what you're focused on, what you're thinking about. And so I'd love to hear, like, where do you see yourself in 10 years? I know 10 years is a long time, a lot can change, but I'm just curious, kind of, where do you see yourself kind of professionally and personally in 10 years?
Well, I've got a 2.5-year-old and a 6-month old. So 10 years seems a long way to think about when you're just trying to survive day to day. It's funny, like I think I'm really happy with what I do. and I really enjoy it. I think people, my hope, I don't know, but I think if people might hate my content, love my content, hate my podcast, I don't know, but I think it would be hard for anyone to listen to me talk about it and think like I don't really enjoy what I'm doing. So my hope is I just continue to really enjoy what I'm doing. And I think the trite but true answers, I hope it's all bigger. I hope it's all better. I hope it's all more profitable. So I think those are all true. But, the other thing, if we were talking 10 years ago, I wouldn't have imagined launching a podcast, to be honest with you. I probably would have said, hey, I really enjoy writing. I would have imagined starting the Substack. So the other answer is, look, I'm just, if it makes sense and it's fun and it's profitable in some way, whether it's, actual money or just like building reputation, getting big, I'm open to trying anything, So that's kind of the answer. I know maybe it's a silly one, but in the stock market, everybody, you actually can't really plan for a lot of stuff. Like sometimes opportunity comes and you see something, it makes sense and you have to hit it. So that would be it, all of it. Like if I discovered I was just like the world's ultimate swing momentum trader and I enjoyed it, I guess I'd change it from, yet another value empire to yet another swing trading momentum empire. I don't know, but just bigger, profitable, more fun, and hopefully just continue enjoying it all the way.
That makes a ton of sense, and I would say that I just as a consumer of your content, I think you do a fantastic job. It seems to me that you're following your own interest. Like today, you sent out a piece. I built a thing with AI, and it's like it's just cool to kind of follow you in real time, and it's very clear that there's a real you're following your own curiosity, your own intellectual interests, and sharing it with everybody, and everybody can benefit from it. So yeah, keep it up, keep it going, and with that, let's switch gears. So the reason why I reached out was because you've been doing this really cool series called the Corporate Dark Arts series, and you've basically been analyzing corporate governance patterns and signals that you've noticed. And one of your articles that you wrote was on two kind of spin-off-y situations. One is Lionsgate, which is a spin-off from last year, and then the Remainco is Starz. And so you notice some really interesting things going on in terms of management incentives and CEO compensation packages. So that was really the catalyst for reaching out and having you on. But before we get into Stars and Lionsgate, I would love to just hear, basically what is this corporate dark art series for those that are interested, and what was the catalyst for sharing it?
Okay, so corporate dark arts is, if I was just backing up, I would say for my entire career, I have just believed in the Charlie Munger. Like I thought I was at the high end of believing in incentives, and the more I do this, the more I realize incentives matter. Now, when I first started, and this is part of evolving as an investor, the way I thought of incentives was two things would like really signal the incentives. Stock buybacks, right? Stock buybacks were the ultimate incentives. If the company was buying back shares, they were saying that their stock was undervalued. And then obviously I'd love to see insider buying, right? And over time, I've come to think those signals are actually a little diminished. I've seen one too many, I've invested in one too many charters where they buy back stock, and it turns out it's a programmatic buy, right? It's very insensitive to value. And then I can't tell you how many times I've been invested and the company says, hey, we think our stock's so cheap, we're going to be buying back shares until the market recognizes our value. And then, kind of the bottom falls out and they stop and they go into distress. And that would be, Bed Bath and Beyond would be the poster child for that. Or, a Liberty Global, which I know you've written about. And I believe you just came on the podcast for it. You talked about Sunrise, but Liberty Global, where they're buying back 10% of their shares every year. And then for some reason, they decide they're not going to, even though, the stock hasn't moved. Allegedly, the value discrepancy is getting larger and they just stop. So I'm kind of to really think those signals aren't as great. Insider buying, I guess, just to finish that out, it's still a good signal. But I've seen one too many companies where the CEO is making $10 million per year, the stock goes down 50%, and the CEO buys $10,000 worth, right? Or a director's been on the board for 8 years and he buys $1,000 worth of stock. And a lot of times the buying is driven by this company has ownership requirements, right? And the buying, you think it's a signal, but what it actually is it's a requirement. And now it's not a bad thing because it's nice for the company's insiders to have a lot more ownership, but you really have to heavily discount it if it's a requirement or if it's kind of the window dressing that I'm alluding to. So the dark arts kind of evolved out of that. And then, I during non-gap, his name's Mike. He wrote non-gap. The Substack's I don't want to say defunct, but he doesn't write a lot anymore. But he was kind of the one during COVID who was like blowing people's eyes up with, hey, companies maybe they always grant their stock options in April, but if they're about to report earnings in late March and they know their earnings are going to be great, they might move the options grant up to mid-March. And then if you see that, you can say, oh, that's curious. And so many times a company will do that and blow out earnings. So the dark arts is the way that the companies can use their kind of insider knowledge and their gain to game the system and create wealth for themselves. And often because they're doing it, an insider can only buy so much. They're limited by their bank account, maybe the margin they can put on it, and how much they can actively trade because the windows are very small. If they're playing around with when they get stock option grants or if they're switching from RSUs to options, they can really make a lot of money quickly when they're doing that. So the dark arts refers to the ways that companies and boards can play around with these things to enrich themselves. And, do I think it's kind of tragic and disgusting that these companies can do this? And, if they were supposed to grant in April, they accelerate it to March, all of that money that they make by doing that acceleration is actually coming from their shareholders. Do I think that's wrong? Yeah, but it's a really big signal and we should be using these signals. So that's the high level. And dark arts has a negative connotation. And as you can probably tell, I do think it's a little dark that they're taking this money from shareholders, but it also is a really interesting way. I used the earnings trigger as an example, but it comes along with a lot of M&A and stuff. So it's a really interesting way to see companies signaling value or perhaps signaling an inflection in value unlock. So I'll pause there, and that's kind of the overarching thesis for the Dark Arts series and
It's
everything.
absolutely fascinating. I mean, it's just so interesting. And such a cool approach. And is there any way to screen for this? I mean, I know the Lionsgate, like you flagged in 8K. Is there any way that you can do this in a systematic way, or do you really have to kind of piece through all the 8Ks?
So it's funny you mentioned that because you mentioned the AI stuff, and I've been saying with the AI stuff, like I've written, get another value blog, great blog, as you mentioned. I appreciate the pitch on the blogging podcast, but I've been writing a lot, and one thing I worry people are going to think is, oh, Andrew's writing these. I mean, I think the stuff I filled is pretty cool, but I wouldn't say any of it's like institutional grade, and people are going to be like, oh, this like quote unquote professional investor making these retailish tools. And the answer is no. Like I'm just in the play stage, the experimentation stage, and obviously I hadn't put everything I've done out there. But one of the reasons I could do the dark arts series is the way I used to identify dark arts is by hand. When I any company I'm following, I try to look at every 8K they file, and if I saw an 8K that I would say, oh, that's a dark arts trick. But that's tough, right? Maybe I follow at the extreme 200 companies, right? And I can't look through all of the 8Ks, so everything was slipping through. What's happened, and I think people might have been better at this than me 2 years ago with like tracking SEC filings and different stuff. But with I can tell it, hey, I'm looking for this specifically, and go back and forth, and I'll say, Lionsgate. I noticed because I follow Lionsgate, but I can then put it into Claude and say, this is a dark arts trigger. If you scan every SEC 8K filing, and if you see anything else that looks like this, I would like you to let me know. And I just go back and forth with it, and I spend hours and hours doing it. But the reason I could write this whole series, and I probably covered 40 different stocks in the series, it's like 12 parts at this point. The reason I could do that is because last year I would find two dark art signals a month because it was me looking through companies I followed and I'd find the trigger. And that's just two dark arts signals. I'm not saying they're trade signals. It's just two dark arts examples. This year, I can find 10 a day because the AI's giving it to me, and then I can go and filter through it. But that's kind of how I've been able to build this series, and that's how I've built the screener to your question. And that's how I'm identifying all of them at this point.
That makes a ton of sense. Okay, let's switch gears and actually talk about one of the companies. So, the two companies that we're going to talk about are Lionsgate and Starz. I think we're going to spend a little bit more time on Lionsgate because I think that one might be a little bit more interesting, and I know you know that one very well. So maybe I'll just turn it over to you. So give me some background on Lionsgate, what Lionsgate is, and what you uncover through this, Dark Arts 8K.
Okay. So Lionsgate is a movie studio. and they also make TV shows. So on the movie studio side, their headline franchise is John Wick, is their big thing. But they also, this is a studio that's been kind of cobbled together over the years. So they have a lot of older stuff in there too. The other headliners in the 2010s, Twilight was a big driver for the stock and a big thing for them. Hunger Games, they're still pumping out Hunger Games content. So they do have other stuff. Rambo, they're going to do, I believe, a Rambo relaunch in the near future, but that's the 80s action classic. They've got Rambo and the thing. And then they also have a TV studio, and the TV studio does a lot of unscripted stuff, and it's also got a lot of premium television. So Lionsgate, and we'll talk about Starz later, but for a while, Lionsgate owned Starz and a lot of the Starz classics. So Weeds, Mad Men, a few others were made under the Lionsgate umbrella. So they've got this movie studio with a TV library. And Lionsgate is it's been known as a mid-tier studio, right? It's not Disney. It's not Warner Brothers. It's not Paramount. It's patched together, but they are a movie studio. So they've been run, and they've got a colorful history, which I think will come into play in a little bit, but they've been run by the same guy for over 25 years at this point. And the reason they popped onto my mind is Lionsgate has always been mentioned as a merger target, right? And I did this article. Maybe you can include a link. I don't know, but I did this article. I followed this for a long time, and back in 2018, the vice chair of Lionsgate, who has a big role, he works with talent and everything. He was saying, "Oh yeah, we are for sale. We're an interesting merger. We're an interesting merger candidate." The exact quote is, he goes on CNBC and says, "Lionsgate is a pint-sized bite for some of these giant market cap companies to acquire, and we're talking to people at all times," right? So I've kind of got them as a boy who cried wolf. They always say they're for sale. Well, the interesting thing to me is they file an 8K, and they give their CEO, who again's been there for 25 years, they give their CEO a bunch of stock options and RSUs that only vest if the stock goes up on the low end 1750 and on the high end 2250. And at the time, the stock is in the 11 to 12 range. And that's interesting on its own, right? That's a stock. But what's really interesting is a lot of the dark arts is about identifying inflections. And, if I said, hey, every 3 years, Lionsgate gives their CEO a new pay package that has stock price triggers, I mean, he's aligned. It's interesting. But he's been here for 25 years, and he's never done one of these stock price triggered packages before. So you look here and you say, oh, this is a CEO who's been here 25 years getting a price heavy target. This seems to me a change in incentives for everyone across the board. He's going to be incentivized to get the stock up in a way that he hasn't before. The company is kind of also putting a marker on, hey, here's what, these things are not granted in a vacuum. Generally, when you grant these, no board wants to spend time negotiating, hire the legal counsel, and give a CEO, if the stock's 2, give them a price target that's at 100 with no path to get to 100, right? Who does that benefit? It benefits no one. So generally what you'll see is the companies and the CEO, they vest these things, and they've kind of got the path in mind that will get them there. And I'm not saying anything's guaranteed. Nothing's guaranteed in life, right? But they're not going to vest something that says the stock's at 11. We think you can get the lowest vesting point is 1750 within 5 years, which is normal-ish performance. But they're going to have a good idea. Like 1750 is you're probably going to hit that. $20 is like base case, and the 2250, good performance, but all of these are going to be triggers. So was the inflection, it was the value signal on all that kind of jumped out to me. So that's the high level. We can talk about any piece of it you want to.
So I think one other thing. So first of all, this was, super interesting because when you flagged this, I think the stock was 11, and it's between 14 and 15 today, depending on where the stock's trading in on May 26th, 2026. But it was a really, really, really interesting email, and I think one other thing that you flagged, which was pretty interesting, maybe you could talk about it a little bit, was that the majority of, or a disproportionate share of the stock, I think, was struck at 1750. I think the different price points were 1750, I think 20 and 2250. But I think you thought it was pretty interesting that a large portion of that was at the lower share price. So what could that potentially mean, or how do you interpret that?
So I want to come back to the history here because I do think it is important here. But no, you hit the nail on the head. Like, this is not the most aggressive package I've ever seen, right? The interesting things about it are, as we discussed, the first sign, the inflection signal, and then B, most of the time when you see this, you'll see if they grant 3 million shares, it will be a million for hitting the low end, a million for hitting the middle, a million for hitting the high end. Or sometimes it'll be like kind of escalating, 500,000 for hitting the low end, a million for hitting the middle, 1.5 million for hitting the high end, which adds up to 3 million, right? So you get really rich if you hit the high end. Here it was the majority of shares vest if you hit the low end, if you hit the 1750, and then you get, it's kind of like I've got the numbers here, but just on the options, there's 4.5 million options in total. 2.5 million of them vest if you hit 1750, another million vest if you hit 20, and another million vest if you hit 2250. That is really strange to say, hey, we're really driving you to the bottom end of the range. And look, again, the stop was 11 or 12, and the bottom end is 1750. These are 5-year options. This is far from the most aggressive target I've seen. That's kind of like 9% annualized to hit the bottom end. I've seen some crazy ones that are like 25% annualized. 9% is like kind of the stock market, right? So the signal to me is not that this is some crazy aggressive. It's the inflection. And then it's that low end, which is kind of seeming to me like they said, hey, we've kind of shopped this around. And I want to come back to the ownership structure in a second because I think it's important. But I think it's kind of saying, hey, we've kind of shopped this around. And we think there might be a private equity bid, and the floor bid for private equity would kind of be 1750. So you're going to get that. And then anything above that is going to be if you can get strategics involved, or if you can get the process really hot, or maybe it's a 5-year window. Maybe if you can spin up a new franchise, John Wick 10 or 12 years ago, nobody saw John Wick. If you can spin up a new franchise, that creates enormous value. So the high end is kind of adding on franchise optionality or strategic getting involved. And the low end is kind of just, hey, get this company sold in the next 5 years.
That makes a ton of sense. Okay, so talk to me about ownership and also kind of the history. So I think in your write up you cover that Lionsgate has kind of made the has not made the right decision at every turn. They've had acquisition offers in the past. They've said they for sale. They bought Starz for I don't know $4 billion. I don't know what the enterprise value of Starz is today. I know it's done very well, but it's below that. So talk to me a little bit about the background, the history, as well as the ownership structure.
So that is the other thing that's interesting here, right? Again, a lot of the corporate dark arts is identifying inflections. And if you traded the Lionsgate of old, right? Lionsgate and Starz used to be, Lionsgate bought Starz in like 2016, 2017. Lionsgate traded under LGF.B. Anyone who bought it knows that. That's because you were buying Class B shares, and the Class A shares were controlled by MHR. And this is a fund that runs a concentrated kind of value style, right? And MHR, I think they have especially previously, before all this, but they had a pretty good track record. But they also were almost notorious in the event-driven space for turning down deals that maybe it's the benefit of hindsight, but deals that would have been wildly accretive. And I'll give you a few examples. Go all the way back to 2007. MHR owns 30% of a company called Leap Wireless. Metro PCS offers $80 per share. MHR is the chairman of the board. They reject the bid as unacceptable. In 2013, Leap is sold to AT&T for $15 per share plus a CV on it. Right now, you can hindsight's 2020, all this sort of stuff, but that's a disaster. There was a company called Loral. Loral used to be this hodgepodge of assets that eventually just became a pure play on Telesat, the Canadian satellite company. In 2014, Loral is in extremely late stage deal talks with Ontario Teachers and PSP, who are the other owners of Telesat. And they're going to buy Loral so that they can collapse the whole Telesat structure. I believe that Ontario Teachers and PSP offer like 85, and they're like literally on the 1 yard line. And then the rumor is Loral kind of says, hey, it's actually going to have to be 90. And the whole deal falls apart. So that's 85 in 2014. Year later, stock's been cut in half. A few years ago, the stock it rolls into Telesat eventually, but obviously the stock's been cut in half. A few years ago, the stock is trading for like $8 per share. It's had a big rally recently thanks to all the space mania. But even after this huge rally, it's trading below the cash price they rejected. It's 12 years ago now, right? So this is you've got this minority stake. You turn down this huge premium bid. It's your disaster. On the Lionsgate side, I do think you give MHR credit because in 2010, Carl Icahn takes a run at Lionsgate and wants to buy them for like $8 or $9 per share. And this is right before Twilight and Hunger Games come out. And, MHR is instrumental in rejecting this. And the stock takes off. It's $40, $50, $60 per share when Twilight's happening. But in the late 2010s, Hasbro offers like $45 per share for Lionsgate. and MHR turns them down, right? And obviously, benefit of hindsight, that's a disaster. In like 2019, CBS offers, I think it's $5 billion for Starz, 5 billion. Lionsgate comes back, and Lionsgate owns all of Starz, and they say they want 5.5 billion. And the deal talks fall apart. And Starz, its enterprise value today is under $1 billion. Disaster, right? So you've got this control shareholder who's got a history of just thinking his assets are worth premium valuations. You have to like hit the tippy top bid, and it works out poorly for shareholders. So when Lionsgate does the spinoff of Starz last year, they also collapse their share structure. So now it's one share per person. And MHR is still the largest shareholder, but Steve Mnuchin is right there with them, right? They basically own the same number of shares. So, and everybody gets one vote. So now Lionsgate, they give the CEO the pay package that incentivizes him, in my opinion, to sell, or says it kind of rewards him for selling. And now you've also got Steve Mnuchin has been buying a lot of this thing. And Steve Mnuchin is a deal guy, right? And now the path is just cleared for this company to sell themselves off. And yeah, so that's kind of the history here that's informing. Like, I really think there's deal talks, and obviously we can talk Warner Brothers, Netflix. We can talk. There's been a rumored legendary bid, but I just think the path is a lot clearer for the company to get sold at this point.
Yeah, no, I think that makes I didn't appreciate that I knew that the share class had been collapsed and that MHR could no longer block bids, but I didn't fully appreciate that they were basically known in the market as just like needing very tippy top dollar to accept a bid.
And that's just me, right? I'm
Yeah.
not saying like maybe other people disagree with me, but I've followed event for a while, and I've seen these events. And there's nothing wrong with thinking you own premium assets, but like just time and time again, you've turned these deal down. And I think a lot of people questioned if Lionsgate could ever get sold without somebody just making a nosebleed offer with the control structure.
And then I think Lionsgate, at the time of the spinoff or shortly thereafter, they put in place a poison pill, which was kind of like a shareholder rights protection agreement that has recently expired. I don't think they're going to renew that. Presumably, that kind of aligns with the dark art signal that this company perhaps could be for sale. How do you think about that?
Small. I don't
Yeah.
think the poison pill is like, I don't know. You've got a company getting spun off, a lot of weird stuff. Like, I think poison pills are generally pretty shareholder unfriendly, but the fact, as you said, they even addressed it on their most recent earnings calls. The fact that Steve Mnuchin might have unlimited Middle East money, I have no idea, but he has been buying a little bit more recently, so maybe they are open to somebody continuing to buy more.
Do you think this asset is valuable? I mean, how do you view, the media space very well, I would say, and how do you think this is a valuable asset? Do you think this would be valuable for potentially private equity, big tech, other studios? Like, how do you view that? Question number one, and then question number two is what is a reasonable, what's a reasonable valuation? Like if we do see an acquisition scenario, like what kind of price do you think would get a deal done?
This is why Lionsgate is really hard to me, right? Because you go look at their SPAC investor deck when they kind of start to merge Lionsgate out of LGF, and they say, hey, you're buying this at 10 times EBITDA, and historical multiples happen at 28 times EBITDA, right? You look at what happens with Warner Brothers. They put themselves up for sale. The stock is, let's just call it 10, 15, whatever you want to call it. Huge bidding war between Netflix and Paramount, and it ultimately goes for 31, and bidding war, like everything. Movie studios historically are worth a lot more dead than alive. The tough thing as an investor is the multiple's big here, right? Like they would say, hey, our studio EBITDA, what you should value us on, was 2000. They just reported fiscal 2026, right? We're recording end of May. They run an off year. They just report. They would say what you should value us on is our studio EBITDA, and that is about $400 million in 2026. And then what they would tell you is, look, 2027 is going to be a blockbuster year. We just released the Michael Jackson movie. That was Lionsgate. That's going to do, I don't know, $1 billion. Like, it's going to be a huge driver for us. We've got this great TV slate that's rolling out. That's good. Like, and there's a lot of operating leverage in the business, right? So they would say $400 million is going up, 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 up. And by the way, you get a ton of operating leverage as it goes up. So they would point you to that. And then they would say, slap a big multiple on that. And it's not crazy to think you could get $30 per share. And the stock's 14. The 22.50 that we mentioned, they've got absolutely in play. But then I think the two counters to that would be, there are a few comments, right? Like the EV is big here. I've got it at with the stock around 15 as you and I are talking. I got the EV if you include the film financing they do. They do about 2 billion of film financing. EV with that is 8 billion, without that is 6 billion. So I mentioned a 400 million studio number. You're already paying between 15 to 20 times that as a standalone with that, depending on how you treat the film obligation. And by the way, there's 140 million of corporate G&A that they're excluding there. And they would say, hey, that a lot of that goes away in a sale. And I would say, yeah, but not all of it, right? Like, yeah, you fire the CEO and chair, but you're still going to have some of that G&A. And by the way, a lot of that 400 million is heavy ad backs. There's 70 million of stock comp in there that we haven't talked about. There's perennial restructuring charges, write-offs. Like, I don't know how clean that number is. So on the downside, the valuation is stretched. The other thing is the IP. When you look at this is not Warner Brothers, right? Warner Brothers has Superman. Warner Brothers has Game of Thrones. You look at the IP, it gets skinny really fast here. Like I just went to their website yesterday. They list their franchises, and their franchises are John Wick. Hey, that's pretty nice franchises. Now You See Me. I love Magic. I love the first movie. Admittedly, haven't seen the second and third one. I hear it does really well in China, but we're already starting to stretch the definition of franchise. Hunger Games, nice franchise. They've already done the books. They're doing brand new IP for the new series. I don't know, Twilight, haven't had a movie there in 15 years. I don't know if I can call that a franchise anymore. Saw, they're trying to reboot it. And then Rambo, which they're going to do the reboot, but we haven't had a movie there in 40 years. So the IP gets skinny fast. And then TV shows. Nurse Jackie is the headliner. Weeds, Orange is the New Black, Nashville. And then the fifth thing they list on TV show is a show called Wicked Tuna, which I've never heard of. But, the IP library gets skinny really quickly here. So they would say, oh, this IP library, this great. I would say, no. And then the last thing I would say is, hey, if Lionsgate is for sale, who is your buyer? You really want to buy. And now maybe it is private equity, and private equity can monetize this library and just slap a ton of debt on it and turn it into a royalty stream. I'm a little suspicious of that. Go look at what's happening to the music royalty business, right? The UMG and stuff. Library over music is much more valuable than library and TV shows. Not a lot of people are watching 1980s sitcom reruns. A lot of people are listening to 1980s music still. I'm not sure if library is as valuable as they would have you say. And so you need a strategic, and tell me who the buyer is. I don't think Netflix is going and looking for somebody after the Warner Brothers bid. NBC, Sony, maybe Apple's doing just fine without buying anyone. Amazon ain't buying anyone after MGM. Like, I don't think they're loving that purchase. So it's kind of hard to see the buyer. And Apple and Netflix built these really nice businesses by themselves without buying anything. So even if one of them decides to buy, they're always going to have the buy versus build hammer on Lionsgate. So those are all the negatives. I will tell you the positive though. The positive is, last negative. If you're a strategic buyer and you're buying Lionsgate, you have to be looking at Paramount and Warner Brothers about to close, and the California AG is saying he's going to sue, and that structural divestments are better than remedies. And you have to be saying, hey, do I want to buy Lionsgate, or do I want to try and pick something off out of Paramount and Warner Brothers? And even if it's not now, Paramount's going to have a heck of a lot of debt when they buy Warner Brothers. Is there going to be a restructuring in 3 years? Could I buy some assets there? And if I buy Lionsgate now, have I kind of shot my wad, whether it's my financial wad or just my regulatory, can I get this over the finish line wad? Am I going to be precluded from that? So those are all your negatives. Here's your positive. The history of the movie studio business is if one is up for sale, there's always a buyer. And it only takes one, right? There's always a buyer, and there's always someone who pays a big premium. And it only takes one. And that is the history of the movie studio business. Whether you're looking at, is it Columbia Coke in the 80s? Whether you're looking in the 90s with Paramount, with Fox coming in for Paramount, and then Barry Diller. Like, the history is there's always one. And you put Lionsgate up, and look at even at 8 billion EV, it's not that big a price tag for a lot of these mega billionaires and trillionaires and big corporations. And do you have, let's use Apple. The studio, the Seth Rogen show, was a big winner for Apple, and that was made by Lionsgate. I also believe Mythic Quest was through Lionsgate. I really like that show. That was Apple. Does Apple look at it and say, yeah, maybe we don't need to buy it, but if we buy it, the new guy who's coming in to replace Tim Cook, he's going to get a lot of relationships with a lot of stars and get to walk a lot of red carpets in a very different way. And when you're approving or not approving it's just a lot different. Maybe. And that's a bite size for Apple. Or if you're worth $50 billion, do you want to be a movie magnate? Kind of like Larry Ellison's son just did. I don't know. And all it does is it only takes one and you make a lot of money. So that's the positive and negatives. I've rambled for probably 10 minutes on the Lionsgate sale process. I'll pause there.
No, that's super helpful. I recently read Morgan Housel's one of Morgan Housel's books called Same as Ever, and he talks about some of the things that just never change. And I think one of the things that could never change is just like people wanting to buy, trophy assets, whether or not buying trophy assets in the past has worked out or not. So I think if you're a Lionsgate shareholder, you're kind of banking on that changing and some bidders coming out of the woodwork, whether it's a billionaire or a big tech company or somebody else. That is a wonderful overview of Lionsgate. Anything else to touch on for Lionsgate before we switch gears and talk about Starz a little bit?
Yeah, the only other thing with Lionsgate, uh, it is interesting. I kind of mentioned buy versus build. I think that's it. But AI is interesting to think about for a movie studio, right? On the top end, you could imagine all sorts of costs, graphic designs, graphic design, editing, all sorts of things getting just slashed by AI. And I think it's probably very positive for the studios. But on the negative end, you could say, hey, AI is just going to fill. If you were a creative person, 20 years ago, you needed a studio to make a movie, right? You needed them to buy the expensive cameras to film. You needed them for the editing, right? You need editors, specialized equipment, all this sort of stuff. And particularly on the CGI, or sorry, the animated, like you really need. But now if you're a creative person, you could probably do a lot of this yourself with AI. And if you want to film a big battle scene, AI can do all the backgrounds and all the special effects for you and everything. It doesn't take a lot. And you see a lot of movies doing pretty well that are just shot on an iPhone, four guys. Like, I think AI is good for them, and I think it's going to be a big margin expansion. But if you told me, hey, the world, like attention's already fragmenting, and there's just not a lot of role for studio in the future because uh, people can get together really creatively and film these stuff, I couldn't believe that. And I would point to Matt Damon and Ben Affleck. They launched that studio, I think it's like Artist Equity or whatever, where the artists take equity. And Blumhouse, like there are studios that are launching. I think the barriers to launching these things, and these are still studios, but they're a lot smaller, and a lot of them are partnering. But the barriers are coming down in interesting ways, and maybe the returns to all the cost cutting from AI accrues to the studios, and it's a bonanza for them. Or maybe the studios are weaker than they were 20, 30 years ago. Maybe studios are a dinosaur thing. And the Netflix and Apple, they've done it without the studio, and AI just means there are 1,000 studios that can get opened up. So I'm not sure, but I don't know. I'm not an expert on the landscape, but it is an interesting thing to think about, and it is going to really change the model.
If you were a betting man, do you think 24 months from now, do you think Lionsgate is an acquired company, or do you still think it's a disappointment? The acquisition didn't go through, and the stock's back below $10.
Uh so it's funny because my gut, the dark
Mhm.
arts and like the rumors, I think this is designed to get sold. But if you're a betting man, I mean, the base rate of anything getting sold is no, right? So if you're a betting man, you always take the no. You always take the no, just because, I mean, 50% plus something to get it sold. I mean, announced mergers are barely 50% to close these days. But I would say much more than the average company Lionsgate is likely to get sold. And I kind of believe that's where everybody's working towards here.
All right, well, let's switch gears and talk about Starz a little bit. So maybe this is basically the remain co of Lionsgate. So the business Lionsgate was spun off. Starz was the remain co. So maybe just give a little background about Starz and why it also popped up on your radar for corporate dark arts.
Yeah, so Starz is the other piece, and most people probably know Starz. This is the premium, like it's the HBO wannabe channel, is what they've always been. They've got Outlander, they've got the Power series, and they've always actually tried. Their whole thing was, we're not trying to grab. I mean, HBO is not trying to grab everyone, but they're trying to grab. Starz was very much programmed. We want minorities, right? Where Power, that's more an African American audience. Outlander, that's more female audience. So they were kind of trying to counter program, if that makes sense. Stars popped up because they did the spin, and look, this thing is just puked. And they give their new CEO, the stock is trading after the spin like between 10 to 14 for a long time. It's optically very cheap, right? It's trading for, let's call it a 900 million EV, in 2025 they do 200 million adjusted. Let's just call it adjusted EBITDA, right? So they're guiding to 100 million of free cash flow in 2026. So this thing is trading very cheap. And they give their with the stock trading between 10 to 14, they give their CEO PSUs that vest if it's three tranches. The first tranche vests if the stock hits $40 by the end of 2026. The second tranche vests if the stock hits 45 by the end of 2027, and the third tranche vests if the stock hits 50 by the end of 2028. And now I'm kicking myself I didn't buy it because it just seems so obvious in hindsight. But like they're granting these things to the CEO, and they only pay off if the stock goes up 4x in 18 months. Like that's kind of crazy. Uh, Starz is a legacy declining business, but I think the interesting thing about Starz is they there are channels that are declining, like the Spike TV that you and I probably saw when we were teenagers, which morphs 1,000 times, or Disney Channel for Kids 3, right? All these channels just go away. The channels that are basically reruns of shows, they're going away. The long tail of cable channels. The interesting thing about Starz is it is not a normal cable channel. Starz is a premium cable channel. So people are choosing to sign up for Starz. Now, maybe they're choosing as part of a bundle package, but they're literally paying money, right? Starz is not some add-on cable channel that, it's the 50th cable channel in a cable company's thing that they're forcing, in a cable network's thing that they're forcing the cable company to take. This is something that people are choosing with their own money to pay for. So if you're saying, hey, AMC, right? AMC, I'm buying that for 6 times EBITDA versus Starz, I'm buying for 6 times EBITDA. I'm taking Starz 1,000 times out of 1,000 because AMC, cord cutting, all this sort of stuff, they might find themselves just kicked off. Whereas Starz, yes, cord cutting affects them, but the subs are actually choosing to pay them. So I think it's interesting because it's a differentiated, unique model, kind of cash cow. It's got this thing. The world going forward is scary for them. It is weird. Like, do you need Starz in a world of Netflix and HBO and Disney Channel and Hulu? I think the answer is no, but they've got people paying for them. The proof is kind of in the pudding there. And the CEO is saying, hey, the CEO is going to get massively rich if he can get the stock to 40. And, it's not a crazy share price that would get them, or sorry, it's not a crazy multiple that would get them to 40. And then the last thing I'll say is, Starz inside of Lionsgate is one thing, but Starz, once it's on its own, maybe they can go acquire some of the cast-offs from other companies. Like a Versant Starz merger would probably make some sense. AMC, like maybe they can acquire the cast-off for a song and like really accrete their way that way. Or maybe this is an attractive bite size for a company that wants a little bit more distribution. Starz Amazon has been a long rumored acquisition. I think that ship has kind of sailed, but that's kind of, you get the dark arts, the stock is just cheap, puked. The CEO has, again, you don't give someone something without some pathway to getting there. The CEO has massive incentive to get there. So that's kind of the dark arts case for Starz.
And how do you think of, in terms of like looking at dark art situations, you see Lionsgate where the premium is much lower than the premium for Starz. So Starz, I think, I don't know where the stock price was when that CEO share price incentives came out, but it was multiples of the current stock price. Whereas Lionsgate was maybe like to hit the lowest tranche, it was like 50% upside, which is great, but it wasn't 200% upside. So how do you think about that when you're looking at like dark art situations? When you see like a kind of a crazy upside versus like a more moderate upside.
So Star stock was 1180 when they make it was given to them in November of 2025. Stock's at 1180, and it requires by the end of 2026 the stock to hit 40. Right, so that is insane. The IRR, my thing is telling me it was a 216% IRR to hit the target. How do I think about that? Look, the thing with dark arts is, now with AI, I can track all of the dark arts grants, right? You probably do okay if you bought them all, honestly, but I don't. What I try to do is I try to marry, okay, let's look at the dark arts grants and let's go see like let's try to figure out what they're seeing and see what it is. Because a lot of them, like a lot of these dark art grants are made when let's use a type, the stock's at 50 cents. It's 9 times EBITDA. They promote some internal person from the CFO to the CEO, and they give them this big PSU package that starts vesting at 2, and you say, oh, they see 4x the value here. No. What they did is they hired some fool and they were like, look, we're screwed, but if you can figure out a way to get us out of this, you'll create generational wealth, right? It's a lottery ticket to encourage them to take the job. I'll see a lot of those. Or, the other one is you'll see a guy who's making $5 million per year in salary, and they'll give them PSUs that will vest. The stock's at 20, they'll give them 3 million of PSUs if the stock hits the 30 in 2 years. And you'll say, oh, this is a line, this is signal value. And I'll be like, yeah, I'm sure the company like sees a path to that value. But is this guy really equity motivated? I don't think so. I think he's stock price motivated. Like what I try to look for is it's not obviously distress. It's someone really backing the truck up and saying like, hey, I'm taking multiples of my salary and I'm putting in an RSU PSU option that vests a lot higher. And look, it doesn't always work, like GTM, what is that? Zoom Info. Their CEO, a lot of people think they had a purchase from private equity. The stock's at 10 in November. They take this huge PSU package that doesn't vest until the stock hits 40 on the low end, 100 on the high end. Well, the stock's 360 today, and they get run over by the SaaS pop-ups, right? And that company is Target One. Charter in 2023, all of the C-suite agrees the stock's at like 400. I can't remember the exact thing. And all of the C-suite agrees we're giving up the next 5 years of equity options and pulling it all forwards to today in performance PSUs with the stock at like 380, and it doesn't start vesting until 530 and it goes all the way up, right? That is a massively bullish signal. But guess what? Fixed wireless gets a lot worse. Fiber overbuilding doesn't slow down, and the stock today is like 150, right? So nothing is guaranteed, but you're really looking for something like Charter, where the company says, hey, throw everything in the past out. We're pulling it all forward right now. We're getting greedy, and nothing's guaranteed, but those are the ones I'm looking for versus, Starz, I think it was, the thing with Starz was it was not distress, right? So they had to have some path. But one of the reasons I give myself a little bit of a pass for missing on it is I looked at it and I was just like, I don't know how they get to 40, And sometimes you'll have companies, and I know several where they're just wedded, cable networks traded for 8 times EBITDA 7 years ago, and the board and everyone hasn't updated. And it's like, hey, now they trade for 5 and it's declining. Maybe this was the case, but it seems like maybe they kind of knew what they were doing too.
Yeah, I mean, I think the other thing with Stars is that people have thrown out is that hey, maybe they can kind of roll up legacy other streaming assets or partner with other cheap media assets and create value that way. And I'm similar to you. I don't I guess that could happen, and we could see a significantly higher stock price that way. Maybe they do merge with Versant, but my pattern recognition is like it's hard for me to picture a world where that's an outcome that really works. One other question that I had for you, are there any like Hall of Fame dark arts situations where like it was maybe you invested in it or maybe you didn't, but like you saw something similar to like the Lionsgate or the Starz and the company wasn't distressed, and this is like the classic case study for like an epic dark arts kind of winner?
I think the most interesting ones to me, there are lots, right?
Yeah.
But the most interesting ones to me right now are when a new CEO who is highly respected comes in. And now it does not always work, right? I would point to Exponential Fitness brought the guy who did the Taco Bell turnaround in a year or two ago and gave him a set of PSUs and did not work out well. And there might have been some backstory and other stuff, but that did not work out well. So it's not guaranteed. But I would point you to 2 cases from earlier this year. And the first might be the best case ever, and I'm just killing myself. I missed it because I hate the business model. But Agillion Health, they hire a new CEO on April 27th. The stock is at, let's just call it 25. And they give him 200,000 PSUs that the low end vests at 50 and the high end vests at 150. On May 6th, 10 days later, they report earnings, and the stock goes from 25 to 50 on the day they report earnings. And as you and I are talking, it's at 90. So in less than a month, the stock has more than tripled. And the first tranche has vested for this guy. The second tranche seems about to vest. And the third tranche is almost certainly going to vest, right? So to me, the signal to me is like new respected CEOs, when they come on and they get PSUs and you look at them like, oh, geez, that is a real signal. Because I've talked to CEOs and CFOs when they go and work at a company, and there's mutual due diligence on both sides, right? And the new CEO is going to come in and he's going to have his own plan, but he's going to get all the company's internals, and they're going to be highly negotiated. Because remember, if you're a CEO and you go to a company and then you get part, like CEO jobs, public CEO jobs are not frequent. And if it doesn't work out, you've just given 2 years of your life, and now you're going to have a nice golden parachute. It's not like you're going to be in the but you may never have a role again. So these guys are actually doing a lot of diligence and especially respected ones. So that's one. And, on the same vein, there was ACHC, which happened earlier this year, where, let me make sure. Yeah. So they had an old CEO who the stock does great under her, and she retires in like 2021, 2022. The company falls apart without her. And earlier this year in January, the company hires her back, right? And as part of hiring her back, she gets 1.1 million options that vest at different prices. And I think the stock was at like 15 at the time. And the low end of the options vest at 25. And the stock was 1168 as I review my notes. And she comes in, the company announces earnings, and the stock is up 100% after they announce earnings, and the first tranche vests immediately. So, like, to me, the ones that are interesting are the ones that are most interesting are new CEO comes in, they have access to the company's business plan, they've got an internal model, and they get a big PSU package. And again, nothing is guaranteed, but those are the most signal, and those are the ones where I've just seen really quickly. A lot of times the company's beating earnings, the analysts are hopping on, the value is unlocked very fast there.
That is absolutely fascinating. This has been like a masterclass in dark arts for me. So I really appreciate you spending an hour with me, Andrew. This has been super enlightening, and really appreciate the time. Anything else you want to mention about dark arts before we wrap up?
No, can't give it all away. Look, I passion. One of the things is I'll just disclose this, like a lot of the dark art stuff that I learned. I'm always open. So like people swap notes with me, or they're like, "Hey, what do you think about this?" And I'll say, "Oh, I'm pretty good at catching most of them these days, but there's still ones I don't." So if you want to swap notes, I'm always happy to swap notes. And the other thing is, a lot of it is bringing the history of the company into it, right? That's what really brings the flavor and says, "Oh, that package is ridiculous," versus, "Oh, that package, I can see why they granted it." So happy to swap thoughts. People can follow me. Get another value blog. I've got 12 pieces in the corporate arts series at this point. It might go up to 13, 14, 15. Who knows? In the LeBron James, not 6, not 7, not 8. But yeah, people can follow me there. I appreciate you having me on. This rambling for an hour on Lionsgate and dark arts and everything has been a lot of fun.
This is so fun. So you are head of research for Rangeley Capital. You have a podcast, Yet Another Value podcast, which I love. You have Yet Another Value blog. You have a free site. You also have a paid Substack, which I'm a subscriber of. If people want to kind of learn more about you, where do you want them to connect or follow
They
you?
should go to yetanothervalueblog.com. What a great website. And they should subscribe. And then if they ever want to talk, they can just reply to any of the emails and say, "Hey, Andrew, what's up?" And that is a very easy way to reach me.
Well, Andrew, really appreciate the time. Thanks so much, man. Really appreciate the insights.
Anytime.